what is a red flag? What we typically call a red flag, it's areas in the tax code or areas on a tax form that taxpayers cheat the most. You're talking meals and entertainment, travel, miscellaneous, these big categories that the IRS, if you get pulled for audit, they're gonna show, hey, prove your travel, prove your meals, because that's the area that people cheat the most. Do we veer away from red flag type tax planning? No, they're red flags because people cheat. We're not cheating. Don't be scared of red flags. I think that's something we hear often is we don't want to file it because it's going to draw too much attention. Who cares? We're going to do it smartly, but at the end of the day, it's going to be safe and it's going to be done right. Don't leave money on the table because you're at risk of audit. Welcome back to Hidden Money Podcast. Today, we are going to be business focused. And if you're just the W-2 earner out there, don't tune us out because a big part of tax planning could be you starting a business and some of this stuff could apply to you. So as a reminder, you're just about a little under 30 days away from your business tax filing deadline if you extended. So that's partnerships and S-corps. If you are a business owner and you extended your tax return, September 15th, that is your deadline to file to be on time. So yeah, we want to really focus on you, the business owner, because a lot of people think about tax planning as an individual thing, and it is. A lot of tax planning is done at the individual level because ultimately that's where the majority of tax, if not all your tax, is probably paid unless you're a C Corp. So individual tax planning is important, but we also don't want to forget about the first layer that is always done is your business. What are you doing inside your business to tax plan before it goes down to your individual?
This is key and important, and I see this so underappreciated or underutilized for one big reason. People who have a business are busy. People who have a business are focused on growing their business.
Yeah.
Yeah, it is the truth, right?
Yes.
You say, that's what you get,
crazy.
Partner.
I know.
You could have still been a senior manager. They're busy. They're focused on it. They have to focus on it. No one else is focused on the business growth and the business improvement as much as the business owner is. And they see taxes as ancillary, or they see taxes as something their strategist is working with during the 2 times a meeting about their 1040, because that's where they pay a lot of their taxes. Most small businesses are correctly set up as a pass-through, meaning that business doesn't pay taxes. And they think, okay, well, since the business doesn't pay taxes, let's do all the tax planning and the strategy, if they are thinking strategy, on my personal return. That's not where, they're missing a big opportunity, and we see this over and over again. So we want to talk about some of the top underlooked items in business tax planning. The first one is you should be tax planning in your business as well as on your personal return. But before we get into that, I would like to point out to everyone in the audience, Kevin Schneider is wearing a sports jacket.
How about it?
I like it.
What you think?
Your shirt's missing a collar.
It's okay.
Is that just a t-shirt, an undershirt?
Yeah, it's just a t-shirt.
You're wearing an undershirt?
Yeah.
No shirt?
Well, it's a nice white, it's not like a Fruit of the Loom shirt. It's a nice white shirt, It's all right.
Okay.
And then I got, there's a collar here.
But you do look good.
I do. I have a collar. I just don't have two collars.
We're improving.
I'm getting there.
We get you a shirt with a collar.
Yeah.
Maybe we get one of those like those priest collars that just you throw on the collar and add.
Or I can get a tuxedo t-shirt. One of those is bound to stick.
All right. So back to business taxes.
Not fashion advice from me.
Yeah, I don't know. There might be a way. This is hard to make clothing tax deductible. But we need to figure out a way so you can buy some nicer clothes.
Well, we've deducted clothing in our business before. When we did Revo t-shirts, we do Revo polos or whatever.
Because that's
marketing stuff. So if, typically with, not to get on too much of a tangent, but I always say with clothing, if you can wear it to dinner, you're probably not writing it off. General rule. Now, we always preach facts and circumstances are different for everybody. If you run a fashion podcast or a fashion business, I would assume I actually had a client I was consulting with last year. She actually has a boutique fashion company, and she develops these color palettes by season. So in the summer, she comes out with a summer palette that are summer colors and everything. And she goes, every meeting I do, I design my own clothes, and I go to fashion shows. I go to all those pop-up shops. I wear my stuff. I'm always marketing my stuff. So I was like, your facts and circumstances are way different than mine. So I take a position with her, like, yeah, deduct your clothing.
Did this client hire us?
Yeah.
And you met
Still
with
a
her on
business.
Zoom?
Yeah.
So she saw how you dress?
Yeah.
And she still
It's
hired
okay.
us?
It's waist up on Zoom. It's fine.
Okay.
She's hiring me not for my fashion advice. I would go to her.
Maybe we can hire her
I
for your
know,
fashion
maybe.
advice. Okay.
But anyway, that's a small, silly example. I would say one of the top things, and I'm working on this actually with an old family member of mine, is when you own a business, and we do this strategy ourselves, so we're preaching to the choir here, but our spouses, our wives, are a big part of our business. And we discussed how travel, a few episodes, maybe a month ago, we discussed how traveling with our spouse was tax deductible because they're officers in our company, and every big business decision we land on between you and I, our spouses have to approve because it's their butts on the line just like ours.
Well, let's be honest. Your wife and my wife run the business. We just ask for permission.
We just
and
say,
eventually
are we
get it.
allowed?
Yes.
But they are owed compensation. And now we don't pay our spouses a W-2 out of the company. There's not earned revenue there because that's not tax efficient. Instead, we do have a 401k.
We do pay them W-2.
We just defer it.
Yes.
Which is where I'm getting.
Okay.
So we don't pay them like a salary ongoing and paying taxes on that. What we do is we've set up, they're part of our 401k plan. So all you business owners out there, you can put your spouse, if they're an officer and they're involved in the business to some degree, you can put them on your 401k and contribute. You can max out our 401k, we max out our 401k, and then we max out our spouses through the business. And so we are doubling up our 401k in our business. Mm-hmm. And that's
And they're not
true and
paying
right.
any income tax on it. They're getting paid the maximum 401k amount that's coming out, but they are paying some FICA on it.
Mm-hmm.
But it's well worth it. And they're able to just pretend. I doubt this is going to be the case. Most likely it's not. But just pretend Social Security's around. When we retire and when they reach retirement age, they'll have Social Security credits from it too. So it's a great deal. Now you and I differ. So my wife is a deferred 401k. I am contributing to a Roth 401k.
best of both worlds, though.
Yeah, so we get
Split
to deduct
difference.
at least one of our 401ks. Yeah. So
You'll be laughing in about 20 years. I'm laughing now.
no, my wife will be laughing in 20 years when I'm dead and gone, and she's using my Roth 401k that's tax-free.
Tax-free. That's
and
right.
keeping hers in there for the kids to deal with later.
There you go.
That'll be funny. All right. There's so many areas we can go. Like, so our producer, our marketing director said we need to like limit this to top 3 areas or whatever. And that's so hard for me because there's a lot more than top 3 areas. There's hundreds of areas that most people overlook in tax planning for business. So I'm just let's just think of on the fly, what are some big ones? I think one big one I don't always see, but man, when I have new client consults who own a business, especially pass-through entity business, which is 95% of our small business client and the small businesses in the country, I ask, hey, have you been planning and strategizing your QBI deduction with your CPA? Well, like a lot of small businesses don't pay a lot of employees. They just pay themselves, right? You have an S corp, they pay themselves, or you have a limited partner, whatever. So I see over and over when we ask for clients, prospective clients, let me see your tax returns from last year. And you look at them and they make $800,000 in taxable income, but they only get like a $6,000 QBI deduction or $12,000. QBI, this is a Section 199 Cap A. It was originally created in the Tax Cut and Jobs Act of 2017. It's now been made permanent in the One Big Beautiful Bill Act. It's still hard for me to say it like that, but for a lot of reasons. But it's now permanent. It allows small businesses to deduct 20% of their taxable income as a phantom deduction. And the point is, C corporations, big companies, Apple, if they actually reported U.S. taxable income, they only pay 21%. But a business owner, the majority of business owners in this country, those who employ more than, I think, 2/3 of the employees of people on payroll in the country, they pay 37% tax. Federal, not to mention state if they're in one of those states, that charge income tax.
Yeah.
If your state does, you can save some state taxes, move to Texas. Great state, great economy, great place to do business. But they paying 37%, big company like Apple paying 21%. That is not fair. So the QBI deduction came out for small businesses to try to put it closer to parity. It's still not a parity. Small businesses still pay more than the big companies. I wish we could change that. Make me king for a day, I would.
Okay.
But QBI deduction. Now, talk to us about the mechanics of QBI and why so many people who don't strategize with it are limited and don't get to take it off.
Because there is a degree of math here. So we don't often do a lot of math on the podcast. I don't do math on stage. You'll make errors. But for the big part of what QBI is, and this isn't true across the whole spectrum of QBI, but generally speaking in QBI deduction, you take your net income of your business, you multiply that by 20%. So let's say your business makes $100,000. You are owed a 20% deduction, $20,000 right off. And that's not cash out the door. It's just, like you said, it's what we call phantom. It's just an additional deduction coming to you of $20,000, making your taxable $80,000.
Pause. That's a tax deduction you get without spending money. So it's a beautiful deduction. And this is one big reason why we're bringing it up now. You should be taking this deduction, but.
Yeah, so if you want to take that full 20% deduction, typically you have to pay double your QBI deduction in wages. So that means you have to have U.S. domestic wages of at least $40,000. So that would mean your business actually made $140,000, but you paid $40 in wages to get your income to $100. Your QBI deduction is $20, and double of $20 is $40. So you get the full $20,000. If you only paid $20,000 of wages on a $20,000 QBI, you would only get a $10,000 QBI. It would be cut in half. So a lot of what we do, especially with small businesses, is the bit like you mentioned. If you're an S corporation, you're probably the only employee on there, or you might have some other employees. But you can always bonus yourself out
or
to
you're
hit the
paying
QBI,
contractors, which we see a lot of times with all our pool
which aren't
company
eligible
clients.
for this calculation.
Right. So contractor pay doesn't count towards the QBI limitation deduction. So in a real world example, and we see this all the time, I'm going to use a bigger number. I'm going to do a factor of 10 here. Instead of 100,000 net income, let's say you make $1 million net income. But you're paying yourself a reasonable salary in your S corp of what anyone else would get paid there doing the job if they weren't the owner. So you're paying $100,000 and you're the only W-2. Everyone else is a contractor for you. So $1 million taxable income, you ought to be able to take a $200,000 tax deduction, but you're only paying yourself $100,000, so you only get a $50,000 deduction. People say, hey, wait, S corp, I always heard, and this was true until 2017, I always heard I should pay myself as little as I can reasonably argue is a reasonable compensation, so I save in Social Security and Medicare and FICA tax, right? Well, that would be true if the QBI wasn't around. And I'm astounded by how many people who are working with CPAs, new prospective clients that have businesses that are in this situation, and I bring up the question when I see that they were limited. No, I never discussed this with my CPA. He never brought it up with me. She never brought it up. You need to bring it up. And it's not just, we stayed with simplicity on the wage calculation. There's also a percentage of, if you have a big capital intensive business, like a lot of equipment, you can get it up there without wages.
SSTB, specified service trade or business
Yeah,
issues.
we're not going to go into all these details.
But the thought would be, if I bonus myself out, let's say I paid myself, let's say I'm owed a $200,000 deduction and my salary was $200,000. I'm not double my QBI deduction, so it's cut in half. Well, what if I bonus myself out another, and this is kind of where the circular reference comes in, if I bonus myself another $200 through payroll, I'm going to hit my Medicare cap. So now I'm only going to be paying 2.9% on anything above $186,000, which means I'm paying not as much in employment taxes as I would be saving in QBI deduction. Your QBI deduction's at 37% deduction, but if I paid myself more salary, I'm going to pay payroll tax on that.
3.9%.
3.9%.
3.8, sorry.
And 15.3 up to the first 180 or whatever it is, and then 2.9%. So at that point, you are paying additional payroll tax up front, but when we prepare your personal tax return, you're going to be saving much more at the 37% bracket. So yes, we're going to play the game smartly. We're going to pay a little bit more to Medicare. We're going to pay a little bit more to Social Security intentionally, but in return, we're going to be saving a lot more federal taxes when it comes down to it.
Yeah, so in Kevin's example, though, if you were already paying yourself $200,000 and you wanted a $200,000 deduction, you've already exceeded the max Social Security cap. So you really are only paying an additional 3.8%, but you're getting an extra $100,000 in deduction if you do this right. An extra $100,000 in deduction at 37%. So if you just do the math, I think I can do this on the stage. $100,000 times 37% is $37,000.
I agree.
But you're paying 3.8% more on $100,000, actually, on $200,000. So you're paying
76.
70, is that right? Yeah, $7,600 more in
Math on
tax
stage, baby.
to get your income up to $400,000 or your payroll.
Yep.
But you're saving $37,000.
Yeah.
Yeah, 37. Sorry.
See,
I was
we
going
did it.
38. Yeah, mostly. So that's the deal. And so many people don't do this.
We try to do that with all of our self-employed clients they can fluctuate those salaries quickly, and it's not going to, we don't advise spending much money out of the business and, hey, I'm going to bonus my employees $100,000. But there's still a leadership, there's still a business aspect to bonusing employees. We're talking, let's bonus yourself, pay yourself more, pay a little bit more tax, payroll tax to save more federal tax.
Now, we don't necessarily follow our own advice there because our team rocks and we need to bonus them to keep them here. So you and I don't have to increase our salaries.
Our QBI is fine.
We just pay a lot
I
of
think
bonuses.
half of our overhead goes to W-2. We're always fine.
I think it was 56% when
It's
you
a lot.
included everything. Yeah, but
Yeah.
that's why we have the team.
Apply at revotaxpayer.com.
Yes. Did you hear that? Apply at revotaxpayer.com. You are taxpayer. All right, another issue, and by the way, just one caveat, our whole discussion there on QBI really focused on S corporations. If you are a partnership or an LLC, you don't pay yourself payroll, so it's different. All right, another big one, home office deduction. It's a red flag, don't do it. Or it's not really that important, why should I do it? Truth is, you file a home office deduction form, that is a red flag because the IRS has caught people cheating there over and over again. Doesn't mean you shouldn't take the deduction, just means you should be able to prove that it's a reasonable deduction. And there's a lot of stuff that's a reasonable deduction. But if you are an S Corp or you are in a partnership, this doesn't apply to disregarded entities, an LLC, single member LLC, it's a disregarded entity, it applies to partnerships, S Corps. If you set up a accountable expense reimbursement plan with your business and yourself, you have to document it. It's got to be created. This is just the documentation internally, unless the IRS asks to prove it. You don't file it with anyone. You can now reimburse your employee, who's you, or your general partner, who's you. You can reimburse them for their home office expenses called office expense. And you get to deduct everything someone could take in a home office, but you get to deduct it as office expense without filing the red flag form. And it's 100% legit, and you should be doing it. And there's a lot of stuff that goes into that.
Oh, yeah. Yeah, and let me define, I can't define it, but what is a red flag? Because that's something that before we get into the nuts and bolts of more home office, because it's really powerful. Red flags are, what we typically call a red flag. It's areas in the tax code or areas on a tax form that taxpayers cheat the most. You're talking meals and entertainment, travel, miscellaneous, just these big categories that the IRS, if you get pulled for audit, they're going to show, hey, prove your travel, prove your meals, because that's the area that people cheat the most. Do we veer away from red flag type tax planning? No. They're red flags because people cheat. We're not cheating. If we do everything legitimately, document, accountable expense reimbursement plans in place, all these small details matter. And if you put those things in place, I don't care if half the country's cheating on this form, I'm still filling it out because if you get audited, I'm just going to slide across the table to prove. So don't be scared of red flags. I think that's something we hear often is we don't want to file it because it's going to draw too much attention. Who cares? We're going to do it smartly, but at the end of the day, it's going to be safe and it's going to be done right. And that's what I'm more important. Don't leave money on the table because you're at risk of audit. Audits you shouldn't be scared of them if you're doing everything the way you should be and doing everything on the up and up. You shouldn't be scared of audits. Audits could be stressful, but they could be time consuming. Agreed with you there, but at the same time, I'm not veering away from them. I'm not scared of them.
But we still try to mitigate the likelihood of being audited. And that's the whole reason we do the accountable expense reimbursement plan to deduct the home office on your business return as office expense versus filing the home office deduction form on your personal return.
We don't want to shine a spotlight on it. So
But we definitely document that kind of,
We
because they
document
can
it.
still audit it.
Yeah.
And if they do,
there's so many small things now that you're talking. There's so many, when we go through a preparation of a tax return, there's so many things that we know how to prepare and just presentation wise in front of the federal government to limit your exposure for audit risk. And just having a smart preparer can limit your risk too. But going back to your home office, sorry, I just wanted to kind of set the stage a little bit of these red flag
you're allowed
things.
to go on tangents occasionally.
So a home office, you are owed that deduction. Now, and I had this conversation with a client just yesterday. I had a call with him, and I was trying to remember, maybe you remember, when did the unreimbursed employee expenses get taken out?
Tax Cut and Jobs Act.
Was that 2017? I couldn't remember if it was Obama or Trump.
It was Trump.
So what happened is if you were...
It was worth it, man. It was
was.
worth it. The Tax Cut and Jobs Act rocked.
If you were an employee, if you're a W-2 earner, you used to be able to deduct your home office expenses, your personal mileage that was unreimbursed by your W-2 employer. You used to be able to deduct that. You no longer can. So home office used to be a lot more powerful for everybody, especially now in this post-COVID environment where everyone can work from home. Home office expense would be huge for not everybody, but a lot more people than it was prior COVID. But as it is now, only business owners can really benefit from the home office. But all it is taking a simple calculation of your square footage of your home, and square footage could look differently for everybody. It has to be a dedicated workspace, but you take the square footage of that in comparison to your home, and you get that ratio. Then you're deducting your portion of that business use ratio against all your household expenses, not all of them. But your property tax, your mortgage interest, if you're in an apartment, your rent,
your cleaning fees.
Your cleaning fees. If you have clients over in your home office as a business owner, I'm probably deducting landscaping. I'm deducting other things because it makes reasonable sense for me to have a presentable property for my clients to come in and buy a tax plan from me or trust me. I need to have my life together. So
we have a
sense.
pool builder client that built a pool right next to instead of a pool house, it's his home office. And he built that to work there, and that's where he works most of the time. And he has clients or prospective clients come out all the time, meet him at the office to see his pool. His entire pool was tax deductible. His pool cleaning fees were tax deductible. His pool maintenance was tax deductible. Mine, not so much.
Man, that's why I know we're good partners, because I have a good buddy that's a pool guy. He's been my friend for 15 years at this point. He renovated his personal backyard, but he has different tiles. He has a fire pit with different tiles. He's got his pool. He's got a shed, all these things, but he has a pool company, and it's his showroom. He legitimately has clients come to his house, and he's like, here's a fire pit. Here's what you could do with it. Here's an example. And I wrote off a good chunk of that backyard.
And that is 100% defendable.
Oh, yeah.
Come on.
So home office. So if you're a business owner and you use any portion of your house as business, I have people house inventory in garages, and your fact set could look who knows what. Speak to somebody, because you're probably leaving money on the table there.
Yeah, and when Ken was mentioning the percentage of square feet, that goes towards indirect expenses. Indirect expenses are expenses that apply both to your normal house and the business. But all direct expenses are 100% deductible on your home office. So the internet that you need, the fiber you need instead of cable, because you can't have a Zoom that drops in the middle of a call or something like that, that's 100% deductible.
Or desk. If you need to buy a new desk for your home office, that's directly associated to the business.
That's where I was going with that. I happen to have a really bad back, apparently. I'm not sure why. Most of it's genetic. But literally, you have 5 lumbar discs, and all of mine are either bulging, ruptured, or slipping and bulging.
And you're going to go on a boat next week.
There's a big difference. This is a cruise on a ship that's bigger than an aircraft carrier. It's a big old Royal Caribbean cruise ship. So, difference.
There is.
I can't explain that to you.
No, I get it.
It's not a boat. It's a ship.
A ship.
A ship with a go-kart track. I mean, it's a ship. Sorry. You made me lose my train of thought. Anyways, the back is getting bad, and it hurts to sit for a long period of time. My job, I got to sit for a long period of time. So it turns out, and it was actually one of my back physicians sent me to this place called, well, they're not sponsors, so I'm not gonna say their name, but a very expensive place that's focused on furniture for people with bad backs. And turns out you can get this chair that's designed specifically for your back, for your ergonomics, for your issues, that works well, and it costs $5,000 for an office chair, desk chair. But it was absolutely necessary for me to be able to do that. That's a direct expense, 5,000. Sorry, I paid 5,000. You
right
paid
there.
495. 1,000.
Okay.
But no, $5,000, and that's tax deductible because that is 100% home office deduction. That's fair, defendable.
Yeah.
So those are direct expenses: computers, printers. Although we don't use printers that much more. I do have a scanner at my home office, so because occasionally people give me paper, I wish they'd stop.
Really?
Yeah. They need to
Who's giving
stop
you
that.
paper?
I'm not gonna name names. Yeah. So, anyways, moving on. I don't want to tell, and that's actually some paid clients. So I'm just not. There have been clients for 20 years, and
There
you're
you
not
go.
going to force them. I mean, you try to convince them, use the portal.
If you've been a client for 20 years, you got some leverage.
some grade.
We'll get you some. We'll take care of you.
Another big one. Oh, wow. We're out of time. Another big one, I guess our last one, that I see overlooked all the time by business owners because I think it's a pain. Business mileage. I think we just saw the excerpt that came out from the IRS procedure, or the ruling or whatever. That was a Rev Proc that came out. New increased business mileage rate. 77 cents now?
It's creeping high.
Like 77 cents a mile.
Well, look at
So-
gas prices and repair costs for everything. But yeah, it should be going up.
It should be going up, but that's significant. But I have so many prospective clients I speak with, even some existing clients that just refuse to work with me on this. They say, look, I was told I have to keep a mileage log. I got to write odometer readings, what the business purpose is, where I'm going, and that just takes too much time. Used to be that way, and it did take a lot of time. Of course I did it, but it did take a lot of time. Now they have got all over the place that automatically record every time you drive your vehicle. And it uses machine AI, and you go in and you just tell it, hey, this place when I go there, that's for work. This place was personal. And it tracks it. And it doesn't matter if I use my personal car 2% for business use during the year, and I use my business car 80% for business use. I got to track mileage on that. That's a big old deduction, especially if you were driving. I mean, let's say you drive 1,000 miles for business in 1 year, and you don't track that. If you don't track it and you get audited, you're going to get in trouble. But just having it, if you track it, 1,000 miles in 1 year, that's $770 of deduction, man.
Sitting out there for doing
For
something
free that you're already doing.
Yeah,
but you're
you're
not
earning
tracking
it. And, like you mentioned, apps are so good. Like iPhone right now, I don't know, I updated my iPhone and it has a new motion car mode or something. You can go into your settings and it puts these dots on your phone. Like iPhone knows when you're in a car. So as soon as you get in a car, you can put the setting on. It helps with motion sickness when you're looking at a phone and you're moving, but these dots kind of move with your phone, with the vehicle, so it keeps you from being car sick. These apps do the same thing. It knows when you're in a car. You don't have to track mileage. It's just tracking it passively in the background, just doing it without you even knowing. And then you just have to swipe business, personal, business, business, personal. You just swipe.
We live in Texas. We're in the South. The big complaint I hear a lot of times from prospective clients or even existing clients, put the app on your phone. I don't want Big Brother watching me. I don't want Big Brother watching me either, but I can't stop it. It's happening everywhere.
You're filmed everywhere.
Like, seriously, how many times have you talked with someone about something you're interested in looking at? A trip, a product. You go to your search engine, I don't care if it's Google, Yahoo, you name it, Grok, whatever. You go to your search engine, you start typing, you take them one letter, boom. The exact thing you were talking about 2 days ago pops up.
Yeah.
Brother's watching. And you don't think the NSA, the CIA, or heck, the KGB, or they're not called
KGB, oh no.
now. What do they call it? Seriously, they're all watching us. Mossad, they know it. You can't hide it. So, I mean, unless you get rid of all your digital devices and go live in a cave.
If
Big
you're in
Brother's
public,
watching you. So
you're
don't pay
getting
extra tax because you're scared of Big Brother watching you. He's already watching you.
These algorithms, they're so good. Like when you're shown an ad, it knows when you're scrolling quickly. And if you stop for like a second, it'll go, Mike, stop for 1 second on this ad and show them more. And then see if they can get you more and more. And that's why.
Is that why I keep seeing Cybertruck ads?
Probably. Quit saying the name, you got to cover your
Stop
mouth.
it, Elon Musk.
But another good thing with the mileage is so you can't deduct commuting. And we'll kind of wrap this up. We're getting long-winded here. But when you commute to a job, whether you're a business owner or you're an employee, you can't deduct that. But for me personally,
well, if you're a business owner, you can. If you're an employee, you can't.
Well, the commuting, you can't commute.
Oh, to your normal daily
to your
commute.
normal daily commute, even as a
Gotcha.
business owner, you can't deduct
Well,
it.
what is a daily?
Yeah. So for me, my fact set is I live about 45 minutes from our office currently. So my actual home office is I work from home a little bit more than I work in the office. I'm in the office probably 2 days, maybe 3 days some weeks. I'm working from home at least 3 to 4 days a week. So my actual home, my main workspace is my home office. So when I drive to my business, that's not a commute for me. That is actual business mileage at that point. So now that we're moving offices, I need to buy a car. I just tax planned for myself. We bought an office and I'm going to be moving. My house is closer, so I'm going to be in office more next year. So I need to buy a vehicle.
As long as you're spending more time working from home. But in reality, come
Next
on,
year.
we're business owners.
We're always at home.
Because we're working until 10 o'clock at night from home.
So anyway, but that's just speak to somebody. Going back to our very first point, being proactive. A lot of people just aren't proactive with their planners. Tell us this information. We don't have client privilege like an attorney, but just the more we know, the more we can kind of develop a defense for our position for you. So thanks for joining us on this episode, and please like, comment, subscribe to this video, subscribe to our channel. Check us out on all the social platforms, and our actual website is revotaxpayer.com. We actually have some hidden money content on revotaxpayer.com now. So go there if you want some more information. Go to YouTube and check out our past videos. But we really want to just create content to bring value to you. We want more clients, yes. But at the end of the day, we really want to change your thoughts and how you view the tax code, and so that you can find that hidden money for your situation and just grow your own wealth. Stop giving it to the government. So
I'm just going to add to that real quick. I'm sorry. I know we are way over time on this episode, but if you know anyone that's paying too much in tax or probably paying too much in tax, share these videos with you. And look, the amount of people that listen to this, we can't handle that many clients. So even if you're not a client of ours, we want you to stop overpaying your taxes. And we want the rest of the country to do it too. So please share our videos or YouTube or podcast
or Instagram or
how many
LinkedIn,
so many
I don't even
platforms. We're on so many platforms. We have to ask our marketing team. I don't know. Thanks for being here. Thank you for listening to this episode. Revo Taxpayer Advocacy, LLC is not licensed or registered as a CPA firm with the Texas State Board of Public Accountancy. I'm a CPA, Kevin's a CPA. We have a lot of CPAs on staff that are licensed and held to the same standards. However, when we decided to be revolutionary and change our name to Revo Taxpayer Advocacy, the State Board would not allow that and let us remain licensed. They say we have to have one of our names in the firm for us to be licensed as a firm. And guess what? It's not us that's important. It's revolutionizing the way you feel about taxes and saving you money. We are advocates for you. So we were willing to drop our firm license, even though we're still individually licensed.